We reviewed this last time for chapter 7 and 13, so it should still be pretty fresh in your mind, hopefully. And so we're asking, what adjusting entry should the company make at the end of the current year to record its estimated bad debt expense? So this is chapter 7. The method that we're using to estimate the allowance for doubtful accounts is the balance sheet approach, which means that I have to pay attention to the balance on the allowance for doubtful accounts. So can anyone tell me what would be the amount that we need to of the adjustment? What's the amount of the adjustment? Basically, we're estimating that 21,750 accounts receivable will be uncollected. Okay, and we have currently a credit balance in our allowance for doubtful accounts. So, what is the amount of the adjustment? Not the adjusting entry, but the amount. Right. So we remember, if we have a credit, we're going to subtract, right? So we started with 21,750. And so we are subtracting 435. And this equals 21,315, hopefully. Okay. And so that means that our journal entry will be the one, number 2, right? If I had numbers in there, it will be this one. This is it right here. Okay. Questions? Remember that if it's a credit, we subtract. If it's a debit, we add. Okay, so moving on to the next one. Here we are asked, okay, see, a company has 94,000 in outstanding accounts receivable. It uses the allowance method. Experiences just a 6% of outstanding receivables. So we're using the balance sheet approach. Are uncollected. The current balance in the allowance is an $840 debit. Okay, so once again, they're asking us for the amount. So what do we have? So Lee, you're correct. We take 94,000, okay, times 6%, which is the 5,640. Now this is the total, okay, of the allowance. The allowance should equal this total. Now we need to go back to the allowance for doubtful accounts and see what balance do we have there. And it happens that we have an $840 debit, which means that we said if we have a debit, we have to add. So Tiffany, you're also right. Okay, so we're gonna take the 5,640. I'm sorry, add it to the 5,640 plus the 840, and that equals 6,480. Okay, and again, bad debt allowance for 6,480, and then credit the allowance 46,480. I know it's not asking for the journal entry, but I just thought I'd throw it out there so you guys can see. All right. Here we're moving on to chapter 13, and it's asking us to calculate working capital. Does anybody recall what the formula is for working capital? Current assets, correct, Chris? Current assets minus current liabilities. So can we identify our current assets? Cash, yes. Short-term investments, correct. AR, that's it. Inventory, and one more. Prepaid, correct. So all these are our current assets, okay? Current assets. And this is long-term, that's why it's not included. And we only have one current liability. So if we were to add these amounts and then subtract our accounts payable, that will be our working capital. So what amount did you guys get for year 2 for working capital? Oops, I think I didn't include my prepaid in that circle, did I? There we go. $238,100. Yes, Lee and Tiffany. Okay, so that's the answer for that. And then this is a refresher, okay, of the asset test ratio. Go back, okay. Asset test ratio is current assets divided by current liabilities, except that we are concentrating on quick assets. Coding. Quick assets. So what would the quick assets be in this example for year 2? We're still in year 2. So cash, I would include short-term investments and receivables, okay? But I will not include the inventory and the prepaid expenses. And of course, plan assets now, right? And then of course, again, we divide it by the only liability that we have. And so if we were to do that for year 2, what would be the answer? And 229 is correct. Okay. All right, moving on to the next one. Here I'm asking for common size percentage. Common size percentage for the balance sheet. For cash. Any takers? It's gonna be our cash, Miss Aria, correct? Divided by our total assets. This information we don't actually need here. Because if we're doing common size for balance sheet, our base is total assets. And then we're just comparing cash versus our total assets. So what's the answer for this one? Correct, 5.89%. Okay, 27,200 divided by 462,000. Okay, just wanted to kind of review that with you. And the last one is the debt ratio. And I wanted to make the, there's a debt to equity ratio and there's a debt ratio. Do we know what the formula is for debt ratio? Yes, in essence, yeah, but we're actually using total liabilities and equity. So we have our liabilities. In this case, our liabilities, we have two liabilities, the 88,000 and the long term of 30,000. And then we divide this by our total liabilities and equity of 352,000. So yeah, total assets, it's the same as total liabilities and equity. But I just like to see it in relation or say it in relation to total equities, because in that way you can see how much is coming from debt versus how much is coming from capital. Okay. And so what would be the answer in this case? Our ratio is, yes, 0.34. So 34% comes from debt, basically. Okay. And the rest is from capital and monies that the company was able to make from its operations. All right, so that concludes the practice exam part. Does anybody have